Good day, everyone. Welcome back to Market Meridian Finance Channel. I'm Eric, and if you've been scrolling through YouTube in the past 12 hours, you've probably noticed 3 financial videos that are blowing up right now. They're dominating the trending page, racking up millions of views in record time, and sparking heated conversations across the global investing community. These 3 videos aren't just random financial content, they're centered around the most pressing economic trends of the moment, trends that are shaping markets, influencing central bank decisions, and impacting every investor's portfolio, whether you're a seasoned trader with decades of experience or just starting out with your first investment account. Today, we're diving deep into all 3 of these viral topics, leaving no stone unturned. We'll break down every key detail, decode the hidden signals behind each trend, and share actionable insights that you can actually use as an investor. No confusing jargon, no unnecessary fluff, just straight, practical, easy-to-understand analysis that will help you make smarter financial decisions in 2026. So, grab a notebook if you want to take notes, sit back, and let's dive right in. First up, let's talk about the most watched video of the past 12 hours, the one from CNBC television, covering the Federal Reserve's March 2026 FOMC meeting. In just 10 short hours, this video has hit a staggering 1.2 million views, and it's easy to see why. It's not just a simple recap of the Fed's decision to hold interest rates steady, it's a deep dive into the cautionary tone of Fed Chair Jerome Powell, a tone that sent ripples through every major financial market, from stocks and bonds to commodities like oil and gold. Before we get into the nitty-gritty, let's set the stage. The Federal Reserve's decisions are the backbone of the U.S. economy, and by extension, the global economy. Every word Jerome Powell says during a press conference can move markets, affect investor sentiment, and even change the trajectory of inflation. For example, back in 2022, when Powell announced a 75 basis point rate hike, the largest single hike in decades, stock markets plummeted, with the S&P 500 dropping 3.6% in a single day. That's how much influence the Fed wields. So, let's start with the basics. What exactly did the Fed announce in this March meeting, and why is everyone talking about Powell's unusually cautious comments? Let's break it down step by step, starting with the key decision itself. Let's get straight to the decision that everyone is talking about. The Federal Reserve kept interest rates unchanged at a range of 3.50% to 3.75% in its March 2026 FOMC meeting. Now, if you've been following the markets closely over the past few months, this wasn't a huge surprise. Most analysts and investors had already priced in a hold, as the Fed has been signaling caution for weeks. But here's the thing, it's not the decision itself that's causing a stir, it's the way Jerome Powell delivered the news, and the unprecedented level of caution he expressed during the post-meeting press conference. One phrase that he repeated multiple times, and which has since become a trending topic on financial social media platforms like Twitter and LinkedIn, is, "No one knows." Let me repeat that, no one knows. No one knows if the US economy will crash or stabilize in the coming months. No one knows how long the Iran-Israel conflict will drag on, or how it will impact global energy supplies. And no one knows how high oil prices will climb, or how that will feed into inflation. This level of candor and caution is rare for a Fed chair, and it tells us exactly how much uncertainty the central bank is facing right now. To put this in perspective, let's think about the Fed's role. Its primary mandate is to maintain price stability, keep inflation low and stable, and maximize employment. For the past year, the Fed has been focused on taming inflation, which peaked at around 9% in 2022, the highest level in 40 years, and has since come down, but is still above the Fed's 2% target. In this March meeting, the Fed confirmed that core PCE inflation, the Fed's preferred measure of inflation, which excludes volatile food and energy prices, was sitting at 2.7%, still above the 2% goal. Now, normally, if inflation is above target, the Fed might consider raising rates to cool the economy. For instance, in 2023, when core PCE was at 3.5%, the Fed raised rates by 25 basis points to 4.75% to 5.00% to curb rising prices. But in this case, they chose to hold steady, and Powell made it clear why: the geopolitical chaos in the Middle East and the resulting spike in oil prices has introduced a level of uncertainty that the Fed can't ignore. Powell also hammered home that the Fed remains data-dependent, which is a phrase we hear often, but it's important to understand what that really means in this context. Being data-dependent means that the Fed won't make any hasty decisions. They'll wait to see how the economy evolves, how inflation responds to higher oil prices, and how the Iran-Israel conflict unfolds before deciding whether to raise rates, cut rates, or keep them steady. Let's break down the data-dependent approach with a simple example. Suppose oil prices continue to rise, pushing up transportation costs, which in turn pushes up the price of groceries, clothing, and other everyday goods. That would cause inflation to stay high, or even rise again. In that case, the Fed might have to keep rates high for longer, or even raise them further, to bring inflation back down. On the other hand, if the Iran-Israel conflict de-escalates, oil prices fall, and inflation starts to drop toward the 2% target, the Fed might consider cutting rates to support economic growth. The Fed is essentially walking a tightrope right now. They're trying to fight inflation without pushing the economy into a recession. It's a delicate balance, and Powell's caution makes perfect sense when you look at the bigger picture. The last thing the Fed wants is to make a hasty decision that either lets inflation spiral out of control or crashes the economy. For example, in the 1970s, the Fed raised rates too quickly to fight inflation, which led to a recession. In 2008, they cut rates too much to stimulate the economy, which contributed to the housing bubble. So, their approach right now is to wait, watch, and react based on the data, and that's exactly what Powell was trying to communicate in his press conference. He wants to avoid repeating past mistakes, and given the current geopolitical climate, that's a wise move. Now that we understand the Fed's decision and Powell's caution, let's take a look at how the markets reacted. Every time the Fed makes an announcement, the markets respond, and this time was no different. Let's break it down step by step, because every market move tells us something important about investor sentiment and the future direction of the economy. First, the stock market. The S&P 500 fell 1.4% by the end of the trading day following the Fed's announcement. Why did this happen? Well, investors were hoping that Powell would signal a possible rate cut in the coming months, but instead, he doubled down on caution, making it clear that rate cuts are not imminent. Rate cuts are usually good for stocks, especially growth stocks. When rates are low, companies can borrow money more cheaply to invest and grow, which boosts their earnings. And their stock prices. For example, in 2020, when the Fed cut rates to near zero, tech stocks like Apple and Amazon saw their prices soar by over 50% in a year. So, when investors realized that rate cuts might not happen anytime soon, they sold off some of their growth stocks, leading to the pullback in the S&P 500. Tech stocks, which are particularly sensitive to interest rates, were hit the hardest. Companies like Apple, Amazon, and Microsoft all saw their stock prices drop by 1.5% to 2% on the day. The Nasdaq Composite, which is heavily weighted toward tech stocks, fell 1.8%, marking its biggest one-day drop in over a month. On the other hand, defensive stocks, companies that sell essential goods like food, utilities, and healthcare, held up relatively well. For example, Coca-Cola stock only fell 0.3%, and Johnson & Johnson stock actually rose 0.2%. This makes sense because defensive stocks are less sensitive to interest rate changes, as people still need to buy these goods regardless of the economy. Next, let's talk about oil prices, which have a direct connection to both the Fed's decision and the Iran-Israel conflict. On the day of the Fed's announcement, oil prices spiked above $110 per barrel, a level we haven't seen in several months. This spike is directly tied to the escalating tensions in the Middle East. Investors are worried that the conflict could disrupt global oil supplies, so they're buying up oil futures to hedge against potential shortages. When demand for oil futures goes up, the price of oil rises, and that's exactly what we're seeing right now. Higher oil prices have a ripple effect on the entire economy. They increase the cost of gasoline, which makes it more expensive for people to drive. They increase the cost of transportation, which makes it more expensive for companies to ship goods, and they can even push up the price of food, since many foods require energy to produce and transport. This is why the Fed is so concerned about oil prices. If they stay high, it could reignite inflation, making it harder for the Fed to reach its 2% target. For example, if gasoline prices rise to $4.50 per gallon, up from the current $3.80, it would add an extra $100 per month to the average household's expenses. That extra cost would leave consumers with less money to spend on other goods and services, which could slow down economic growth. It's a vicious cycle. Higher oil prices lead to higher inflation, which leads to the Fed keeping rates high, which leads to slower economic growth. Then there's gold, which is usually considered a safe haven asset. When markets are volatile, investors flock to gold because it holds its value even when other assets like stocks are falling. But this time, gold actually retreated slightly, falling by about 0.3% on the day. Why is that? Well, it all comes down to bond yields. Gold doesn't pay interest, so when bond yields rise, gold becomes less attractive to investors. They can get a better return by investing in bonds instead of holding gold. And bond yields rose on the day of the Fed's announcement because investors priced in the Fed's reluctance to cut rates. They're expecting rates to stay high for longer, so bond yields adjusted accordingly. The 10-year U.S. Treasury yield rose from 3.8% to 3.95% on the day, which is a significant jump. This is a key point to remember. Gold isn't always a safe bet in every market condition. It's important to understand how it interacts with other assets like bonds and interest rates. For example, during periods of high inflation and low interest rates, gold tends to perform well. But during periods of high interest rates, gold can struggle. So, if you're thinking about adding gold to your portfolio, you need to consider the current interest rate environment. Now, let's talk about what this means for you as a retail investor, someone who's investing for the long term, maybe saving for retirement, a home, or your children's education. The most important takeaway here is that volatility is here to stay. If you're invested in stocks, especially growth stocks or tech stocks, you need to be prepared for more swings in the coming weeks and months. This doesn't mean you should panic and sell all your stocks, far from it. Instead, it means you should focus on your long-term goals and avoid making impulsive decisions based on one day's market move. If you're looking for safe havens to protect your portfolio from volatility, don't just rely on gold. Consider other assets like U.S. Treasury bonds, which are considered one of the safest investments in the world, or defensive stocks, companies that sell essential goods like food, utilities, or healthcare. These stocks tend to hold up better during market volatility because people still need to buy these goods regardless of the economy. For example, during the 2020 COVID crash, Coca-Cola stock only fell 20%, while the S&P 500 fell 34%. Another important point, don't try to time the market. Many investors make the mistake of trying to buy low and sell high, but this is extremely difficult to do consistently. For example, a study by Dalbar Incorporated found that the average investor underperforms the S&P 500 by over 10% per year because they buy high and sell low based on emotions. Instead, focus on dollar-cost averaging, investing a fixed amount of money at regular intervals, regardless of market conditions. This way, you buy more shares when prices are low and fewer shares when prices are high, which can help reduce the impact of volatility on your portfolio. And most importantly, don't panic, market volatility is normal. Over the long term, the stock market has always trended upward, even through wars, recessions, and geopolitical chaos. The key is to stay patient, stay disciplined, and focus on your long-term goals. Let's take a quick moment to summarize what we've learned about the Fed's March meeting and the market reaction. To put it in simple terms, the Federal Reserve is playing it safe. They're holding interest rates steady at 3.50% to 3.75%, and Jerome Powell is warning us that there's a lot of uncertainty ahead. The two biggest wildcards right now are the Iran-Israel conflict and the resulting spike in oil prices, both of which could push inflation higher, slow down the economy, or both. These two factors will continue to influence the Fed's decisions in the coming months, so it's important to keep an eye on how they unfold. For example, if the Iran-Israel conflict escalates further, oil prices could rise to $120 per barrel or higher, which would put more pressure on inflation and force the Fed to keep rates high for longer. For you as an investor, the key takeaway is to stay patient. Don't make impulsive decisions based on one press conference or one day of market moves. Focus on your long-term investment strategy, diversify your portfolio, and remember that volatility is part of investing. Trying to time the market or panic selling when prices drop is one of the biggest mistakes investors make, so avoid that at all costs. For example, if you had sold your stocks during the 2020 COVID crash, you would have missed out on the subsequent recovery, where the S&P 500 rose by over 70% in a year. Now, before we move on, let's make a quick connection to our next topic. The Iran-Israel conflict and rising oil prices aren't just impacting the Fed's decisions. They're also creating a massive financial windfall for one country that you might not expect. Russia. While the West has been imposing sanctions on Russia for years, the Middle East chaos has allowed Russia to earn billions of dollars in extra oil revenue. This is the second viral video we're going to dive into today, one from the channel Money and Macro that's been watched nearly 900,000 times in just 8 hours. It's a fascinating story of how geopolitical chaos can create unexpected winners, and it has huge implications for global energy markets, geopolitics, and even your investment portfolio. So, let's move on to Module 2, where we'll explore Russia's unexpected oil windfall. It's time to turn our attention to the second viral financial video of the past 12 hours, this one from the channel Money and Macro, which has racked up 890,000 views in just 8 hours. The headline of this video says it all: Russia is earning an extra $5 to $6 billion per day from oil sales, thanks to the chaos in the Middle East. Let me repeat that number, $5 to $6 billion per day. That's not a typo. To put that in perspective, Russia's annual budget deficit in 2025 was around $150 billion. At this rate, they could erase that entire deficit in just 1 quarter, 3 months. That's a staggering amount of money, especially for a country that's been under Western sanctions for years. So, the question on everyone's mind is, how is this possible? How is a country that's supposed to be isolated by Western sanctions reaping such a massive financial windfall? And what does this mean for the global economy? Geopolitics, and your investments. Let's break it down step by step, starting with the key concept that's driving this windfall, the substitution effect. This is a basic economic principle, but it's crucial to understanding what's happening with Russia's oil sales right now. First, we need to understand what's called the substitution effect, a simple economic concept that's at the heart of Russia's oil windfall. Let's keep this as simple as possible. When the supply of one product is disrupted, people and countries will look for alternative products to replace it. In this case, the product is oil, and the disruption is the Iran-Israel conflict. As tensions in the Middle East escalate, investors and oil importers are worried that the conflict could disrupt global oil supplies, especially from Iran, which is a major oil exporter, responsible for about 4% of global oil production. So, to avoid being caught off guard by a potential shortage, many countries are scrambling to find alternative sources of crude oil. And that's where Russia comes in. Despite being under Western sanctions since the start of the Ukraine war in 2022, Russia is one of the world's largest oil exporters, second only to Saudi Arabia, accounting for about 12% of global oil production. For years, Western countries have imposed sanctions on Russian oil, banning imports of Russian crude and trying to cut off Russia's access to global oil markets. The G7 even imposed a price cap of $60 per barrel on Russian oil in 2022, hoping to limit Russia's revenue. But here's the key, not every country in the world is on board with these sanctions. Two of the world's largest oil importers, India and China, have been buying massive amounts of Russian oil at a discount for years, and now, with Middle East oil supplies at risk, their demand for Russian oil has skyrocketed. This surge in demand has pushed up the price of Russian oil, narrowing the discount that Russia has had to offer to sell its crude. Let's look at the numbers to see just how much this has helped Russia. Before the Middle East conflict escalated, Russia was selling its crude oil at a discount of $10 to $15 per barrel compared to international benchmarks like Brent crude, which is the global standard for oil prices. For example, if Brent crude was trading at $100 per barrel, Russian crude was selling for $85 to $90 per barrel. But now, that discount has narrowed significantly. Some reports say it's down to just $2 to $3 per barrel, and in some cases, Russian oil is selling at near Brent prices. That might not sound like a big difference, but when you're selling millions of barrels of oil per day, it adds up fast. Let's do a quick calculation to put this in perspective. Russia exports around 5 million barrels of oil per day. Before the Middle East conflict, the discount was $10 per barrel, so Russia was losing out on $50 million per day, 5 million barrels x $10 discount. Now, with the discount down to $2 per barrel, Russia is only losing out on $10 million per day. That's a difference of $40 million per day in extra revenue. But wait, that's not all. Global oil prices have also risen, from around $90 per barrel to over $110 per barrel. So, not only is the discount smaller, but the overall price of oil is higher. When you combine these two factors, Russia's oil revenue has skyrocketed. Western media calculations show that this narrowed discount, combined with higher global oil prices, is giving Russia an extra $5 to $6 billion per day in oil revenue. That's enough to fund its war in Ukraine, stabilize its economy, and even build up its foreign reserves, all while Western sanctions were supposed to cripple its finances. For example, Russia's military spending in 2025 was around $100 billion, which is less than 2 weeks of extra oil revenue at current rates. That's how significant this windfall is. Another key point to understand is the role of India and China in this windfall. India has become Russia's top oil importer, buying more than 1.5 million barrels of Russian oil per day. China is close behind, buying around 1.2 million barrels per day. Together, these two countries account for more than half of Russia's oil exports. Why are they buying so much Russian oil? Because it's cheaper than oil from other sources, and it helps them reduce their reliance on Middle Eastern oil. For India and China, buying Russian oil is a win-win. They get a reliable source of oil at a lower price, and Russia gets a steady stream of revenue. This has allowed Russia to bypass Western sanctions and continue to earn billions of dollars from oil sales. Let's take India as an example. India is the world's third largest oil importer, and it relies on imports for over 80% of its oil needs. Before the Ukraine war, India imported very little Russian oil, less than 1% of its total imports. But now, Russian oil accounts for over 20% of India's oil imports. Why? Because Russian oil is cheaper. For example, in 2023, India was buying Russian oil at $70 per barrel, while Brent crude was trading at $85 per barrel. That's a savings of $15 per barrel, which adds up to billions of dollars per year for India. It's a no-brainer for India to buy Russian oil. It helps them lower their energy costs and reduce their reliance on Middle Eastern oil, which is often subject to geopolitical tensions. It's also important to note that Russia has been smart about its oil exports. It has built new pipelines and shipping routes to send oil to India and China, bypassing Western ports and financial systems. This has made it harder for Western countries to enforce their sanctions, as Russia no longer relies on Western banks or ports to sell its oil. For example, Russia now ships most of its oil to India via the Indian Ocean, using ships that are not registered in Western countries, which makes it harder to track and sanction. Russia has also started using its own currency, the ruble, and China's yuan, to conduct oil transactions. Bypassing the US dollar. This has further weakened the impact of Western sanctions. Now that we understand how Russia is earning this massive oil windfall, let's talk about the long-term implications for Russia, for the global energy market, for India and China, and for you as an investor. Let's start with Russia. This extra oil revenue has given Moscow more financial flexibility than anyone expected. Before the Middle East conflict, Russia was facing significant economic pressure from Western sanctions. Its economy was growing slowly, its currency, the ruble, was volatile, and it was struggling to fund its war in Ukraine. But now, with an extra $5 to $6 billion per day in oil revenue, Russia's economy is stabilizing. The ruble has strengthened, from around 75 rubles per dollar in 2025 to around 65 rubles per dollar now. Inflation in Russia has fallen from 12% in 2022 to 5% in 2026, which is close to the Central Bank of Russia's target of 4%. The government has more money to fund its military and social programs, which has helped to maintain public support for the war in Ukraine. This means that Russia is now more financially secure than it was just a few months ago, which could prolong the war in Ukraine. It also means that Western sanctions are becoming less effective, as Russia has found a way to bypass them and earn massive revenue from oil sales. This is a major blow to the West's strategy of isolating Russia. Next, let's look at the global energy market. Russia's growing role as an oil exporter is shifting the global energy landscape. For decades, the Middle East has been the dominant player in the global oil market, with Saudi Arabia and Iran leading the way. But now, Russia is becoming an even more important player, especially as Middle East supplies become more uncertain. The world is becoming more dependent on Russian oil, even as Western countries try to reduce their reliance. This could lead to more volatility in oil prices, as any disruption to Russian oil exports, like a new round of sanctions, a natural disaster, or political instability in Russia, could have a huge impact on global oil supplies. It also means that Russia has more influence over global energy prices, which could be used as a geopolitical tool. For example, Russia could choose to cut oil production to push up prices, or increase production to lower prices, depending on its geopolitical goals. In 2023, Russia cut oil production by 500,000 barrels per day to push up prices, which helped to boost its revenue. This kind of control over oil prices gives Russia more leverage in global affairs, which is a concern for Western countries. Now, let's talk about India and China. Their continued purchases of Russian oil have put them in a tricky geopolitical position. On one hand, they want to maintain good relations with the West, which is a major trading partner for both countries. The US is India's second-largest trading partner, and the EU is China's largest trading partner. On the other hand, they rely on Russian oil to meet their energy needs at a lower cost. So, they're trying to balance these two interests, buying Russian oil while not angering the West. So far, they've been successful. The West has criticized India and China for buying Russian oil, but has not imposed any significant sanctions on them. This balance is likely to continue, as India and China prioritize their own energy security over Western pressure. For these two countries, the benefits of buying cheap Russian oil outweigh the risks of angering the West. Finally, let's talk about what this means for you as an investor. The most obvious impact is on oil prices. With Russia's oil revenue soaring and Middle East supplies uncertain, oil prices are likely to stay high in the near future. This is good news for energy companies, especially those that have exposure to Russian oil or oil exploration in general. Companies like ExxonMobil, Chevron, and BP could see their profits rise as oil prices stay high. For example, ExxonMobil's profits in 2023 rose by 40% when oil prices averaged $85 per barrel. If oil prices stay above $110 per barrel, their profits could rise even more. It's also good news for countries that are major oil exporters, like Saudi Arabia and Canada. But it's bad news for consumers and businesses, as higher oil prices will lead to higher gasoline prices, higher transportation costs, and higher inflation. This could slow down global economic growth, which could impact stock markets around the world. As an investor, you should consider adding energy stocks to your portfolio to hedge against higher oil prices, but you should also be cautious of the impact of higher inflation on other sectors, like consumer discretionary, companies that sell non-essential goods, and tech. For example, higher inflation could reduce consumer spending on things like travel and electronics, which would hurt companies in those sectors. Let's wrap up our discussion of Russia's oil windfall with a quick summary. The Middle East conflict has turned out to be a huge financial boon for Russia. Thanks to the substitution effect, countries are turning to Russian oil as Middle East supplies become uncertain, pushing up the price of Russian crude and narrowing the discount. This has given Russia an extra $5 to $6 billion per day in oil revenue, which has stabilized its economy and allowed it to fund its war in Ukraine. Western sanctions are becoming less effective, as Russia has found a way to bypass them by selling oil to India and China. The long-term implications are significant. Russia's influence in the global energy market is growing, the global energy landscape is shifting, and oil prices are likely to stay high in the near future. This could lead to higher inflation around the world, which would impact central bank decisions, including the Fed's. For example, if oil prices stay high, the Fed may have to keep rates high for longer to fight inflation, which would further impact stock markets and bond yields. For you as an investor, this is a reminder that geopolitical events can have a huge impact on commodity prices and global markets. You can't ignore these trends if you want to make smart investment decisions. Consider adding energy stocks to your portfolio to hedge against higher oil prices, but also be mindful of the impact of higher inflation on other sectors. Now, let's move on to the third viral video of the past 12 hours, one that's signaling a major shift in the global financial system. Central banks around the world are on a gold buying spree. This video from the Plain Bagel has been watched 720,000 times in just 6 hours, and it's easy to see why. It's about a historic trend that's flying under the radar for many investors, but it has huge implications for the US dollar, inflation, and your investment portfolio. So, let's move on to Module 3, where we'll explore why central banks are buying so much gold, and what it means for you. Then let's turn our attention to the third viral financial video of the past 12 hours. This one from the Plain Bagel, which has racked up 720,000 views in just 6 hours. This video focuses on a historic trend that's flying under the radar for many investors. Global central banks have been buying gold for 16 consecutive months. That's over a year of non-stop gold purchases, and the numbers are staggering. Central banks around the world have added over 2,300 tons of gold to their reserves, which is worth more than $387 billion at current prices. And analysts believe that the actual amount of gold being bought is even higher, around 4,600 tons, because some central banks don't report their gold purchases publicly. This is unprecedented. Central banks don't buy gold on a whim. This is a strategic move, and it's a sign of a major shift in the global financial system. For decades, central banks have held most of their reserves in US dollars and other fiat currencies, but now they're increasingly turning to gold. So, the question is, why are central banks buying so much gold? And what does this mean for the US dollar, inflation, and your investment portfolio? Let's break it down step by step, starting with the three main reasons behind this gold buying spree. There are three main reasons why central banks are ditching US dollars and other fiat currencies for gold, and all three are directly tied to the trends we've already talked about: geopolitical tension, inflation, and de-dollarization. Let's start with de-dollarization, which is perhaps the most significant reason. For decades, the US dollar has been the world's reserve currency, meaning that most international trade is conducted in dollars, and most central banks hold their reserves in dollars. This gives the United States a lot of power in the global financial system. For example, the US can impose sanctions on other countries by cutting off their access to the dollar-based financial system. But in recent years, more and more countries have been looking to reduce their reliance on the dollar, for a variety of reasons. One of the main reasons for de-dollarization is the rise of geopolitical tensions. Countries like China, Russia, and India are tired of being dependent on a currency that's controlled by the United States, especially as US sanctions become more frequent. For example, when the US imposed sanctions on Russia in 2022, it cut off Russia's access to the dollar-based financial system, making it harder for Russia to conduct international trade. This scared other countries, who realized that if they anger the US, they could face the same fate. So, they're looking for alternative assets to hold in their reserves, assets that are not tied to any single country or government. Gold is the perfect choice for this, because it's a neutral asset. It's not controlled by any government, it holds its value over time, and it's accepted around the world. So, central banks are buying gold to reduce their reliance on the dollar and protect their reserves from US sanctions. Let's take China as an example. China has been one of the biggest proponents of de-dollarization in recent years. In 2023, China and Saudi Arabia signed an agreement to conduct oil trade in yuan instead of dollars. This was a major blow to the dollar's dominance in the global oil market. China has also been buying massive amounts of gold to reduce its reliance on the dollar. In 2025 alone, China added over 500 tons of gold to its reserves, bringing its total gold reserves to over 2,500 tons. This is a clear sign that China is trying to reduce its dependence on the dollar and build a more diversified reserve portfolio. The second main reason for the gold buying spree is inflation. As we've talked about earlier, inflation is still above target in many countries, and soaring oil prices are threatening to push inflation even higher. Gold has been a classic hedge against inflation for centuries. When the value of money, fiat currency, decreases, the value of gold tends to increase. This is because gold is a tangible asset with limited supply, while fiat currencies can be printed in unlimited quantities by central banks. For example, during the 1970s, when inflation in the US reached double digits, the price of gold skyrocketed from around $35 per ounce to over $800 per ounce. That's a gain of over 2,200% in just a decade. Central banks are well aware of this history, so they're buying gold to protect their reserves from losing value as inflation rises. If inflation stays high, the US dollar and other fiat currencies will lose purchasing power, but gold will hold its value. That's why central banks are stockpiling gold. They're preparing for a future where inflation is higher and fiat currencies are less valuable. For example, if inflation in the US rises to 5% per year, the purchasing power of the dollar will be cut in half in just 14 years. but gold, which has maintained its value for thousands of years, will protect central banks' reserves from this erosion. The third main reason is rising geopolitical risk. We've talked about the Iran-Israel conflict and the Russia-Ukraine war, but there are also tensions between the US and China, instability in the Middle East and Africa, and growing uncertainty about the future of the global economy. In times of crisis, gold is a safe haven asset. It holds its value even when markets crash, currencies devalue, or wars break out. For example, during the 2008 financial crisis, the price of gold rose by over 20% while stock markets around the world crashed. During the COVID-19 pandemic in 2020, gold prices rose by over 30% as investors sought safety. Central banks are buying gold to prepare for future uncertainty. They want to have a safe asset in their reserves that they can rely on if the global economy collapses or geopolitical tensions escalate further. This is especially important right now, as the world faces more uncertainty than it has in decades. Let's look at some specific examples to illustrate this trend. China, which is the world's second largest economy, has been one of the biggest buyers of gold in recent months. In 2025 alone, China added over 500 tons of gold to its reserves, bringing its total gold reserves to over 2,500 tons. Russia has also been a big buyer. Since the start of the Ukraine war, Russia has added over 300 tons of gold to its reserves, as it looks to reduce its reliance on the dollar. Even smaller countries are getting in on the action. Countries like Turkey, India, and Brazil have all increased their gold reserves in recent months. This is a global trend, and it's not going away anytime soon. Now that we understand why central banks are buying so much gold, let's talk about what this means for the US dollar and for you as an investor. First, let's talk about the US dollar. If central banks continue to sell dollars and buy gold, it could weaken the dollar's status as the world's reserve currency. For decades, the dollar has been the dominant reserve currency, accounting for around 60% of global central bank reserves. But this gold buying spree is a sign that countries are losing faith in the dollar. A weaker dollar would have both positive and negative effects. On the positive side, it would make US exports more competitive, because US goods would be cheaper for other countries to buy. This could help boost US economic growth and create jobs. For example, if the dollar weakens by 10%, a US-made car that costs $30,000 would cost €27,000 in Europe instead of €30,000, making it more attractive to European buyers. On the negative side, a weaker dollar would lead to higher inflation in the US, because imported goods would become more expensive, pushing up prices for consumers. It could also make it more expensive for the US government to borrow money, as foreign investors would demand higher interest rates to compensate for the weaker dollar. It's a double-edged sword, and it's something we'll be watching closely in the coming months. Now, let's talk about what this means for you as an investor. The gold buying spree by central banks presents a clear opportunity. Gold can be a valuable hedge against uncertainty, inflation, and a weaker dollar. If you're looking to protect your portfolio from these risks, adding gold to your portfolio is a smart move. But there are a few things you need to keep in mind. First, don't put all your money into gold. Gold is a great hedge, but it doesn't generate any income, unlike stocks, which pay dividends, or bonds, which pay interest. So, it should be part of a diversified portfolio, not the entire portfolio. Financial experts recommend that investors allocate 5 to 10% of their portfolio to gold. Second, be aware that gold prices can be volatile in the short term. Even though the long-term trend is up, gold prices can fluctuate significantly from day to day. For example, in 2023, gold prices rose by 18% overall, but they had a pullback of 10% in just 1 month. So, you need to be prepared for that volatility and not panic if gold prices drop in the short term. Third, there are multiple ways to invest in gold. You can buy physical gold, like coins or bars, gold ETFs, exchange-traded funds, or gold mining stocks. Each option has its own pros and cons. Physical gold is tangible and gives you direct ownership, but it can be expensive to store and insure. Gold ETFs are more liquid and easier. To trade, and they track the price of gold closely. Gold mining stocks can offer higher returns than physical gold or ETFs, but they're also more volatile, as they're affected by factors like mining costs, production levels, and company management. So, you should do your research to find the one that's right for you. One question that many investors are asking is gold in a bubble? Let's be honest, gold prices have risen significantly in the past 16 months, up by around 18% since the start of the gold buying spree. But analysts believe that the trend is just getting started. As de-dollarization continues, geopolitical tensions persist, and inflation remains above target, demand for gold is likely to stay strong. So, while gold prices may pull back in the short term, the long-term trend is upward. That being said, it's important to avoid buying gold at the peak of a short-term rally. Instead, use dollar-cost averaging to buy gold over time, which will help reduce the impact of short-term volatility. Let's take a quick moment to summarize what we've learned about central banks' gold buying spree. This unprecedented trend is driven by three key factors: de-dollarization, inflation, and rising geopolitical risk. Central banks are buying gold to reduce their reliance on the US dollar, protect their reserves from inflation, and prepare for future uncertainty. This trend is signaling a major shift in the global financial system. The US dollar's dominance is being challenged. And gold is regaining its role as a global reserve asset. For you as an investor, gold is a valuable tool to hedge against uncertainty, inflation, and a weaker dollar, but it should be part of a diversified portfolio. Always do your own research before investing in gold, and avoid making impulsive decisions based on short-term price movements. Remember, the goal of investing in gold is to protect your portfolio, not to get rich quick. Now, let's wrap up with a quick recap of all three hot topics we've covered today, and share some final advice for you as an investor. All three of these viral videos are interconnected. The Iran-Israel conflict is driving up oil prices, which is influencing the Fed's decision to hold rates steady, and both of these factors are pushing central banks to buy more gold. It's a chain reaction that's shaping the global economy and financial markets, and it's important for you to understand these connections if you want to make smart investment decisions. So, to recap the three hottest financial topics of the past 12 hours, first, the Federal Reserve is holding interest rates steady at 3.50% to 3.75%, and Jerome Powell is warning of significant uncertainty ahead, driven by the Iran-Israel conflict and soaring oil prices. The Fed is walking a tightrope between fighting inflation and avoiding a recession, and their data-dependent approach means we'll see more caution in the coming months to $6 billion per day, thanks to the substitution effect driven by Middle East oil supply uncertainty. This windfall has stabilized Russia's economy, weakened Western sanctions, and shifted the global energy landscape, keeping oil prices high and fueling inflationary pressures worldwide. Third, central banks have been on an unprecedented gold buying spree for 16 straight months, driven by de-dollarization, inflation fears, and rising geopolitical risks, signaling a major shift away from the US dollar's dominance and toward gold as a safe haven reserve asset. Now, let's leave you with some final, actionable advice that ties all these trends together. First, embrace volatility, don't fear it. The global economy is in a period of uncertainty, with geopolitical tensions, inflation, and shifting monetary policies creating swings in markets. But volatility also creates opportunities. For long-term investors, These swings are a chance to buy quality assets at lower prices, especially if you're using dollar-cost averaging. Remember, the most successful investors aren't the ones who time the market, they're the ones who stay disciplined and stick to their strategy. Second, diversify your portfolio. We talked about defensive stocks, US Treasury bonds, energy stocks, and gold, and each has a role to play. Don't put all your eggs in one basket. If you're heavily invested in tech stocks, consider adding some energy or defensive stocks to hedge against inflation. If you're looking for safety, allocate 5 to 10% of your portfolio to gold, either through ETFs or physical gold. Diversification is your best defense against market uncertainty. Third, stay informed. Geopolitical events, like the Iran-Israel conflict or shifts in US-China relations, are no longer just news, they're drivers of market movements. Keep an eye on oil prices, Fed announcements, and central bank gold purchases. These are the signals that will help you make smarter investment decisions. You don't need to be an expert, but you do need to stay curious and keep learning. That's why we're here, to break down these complex trends into easy-to-understand insights for you. Before we wrap up, I want to hear from you. Let's start a conversation in the comments below. Do you think the Fed will cut rates by the end of 2026? Are you adding gold to your portfolio this year? Or do you think Russia's oil windfall will continue as long as the Middle East conflict persists? Drop your thoughts below. I read every comment, and I'll even respond to some of you in our next video. And if you found this video helpful, don't forget to like, subscribe, and hit the notification bell. We post weekly financial analysis breaking down the biggest trends moving markets, so you never miss an update. Whether you're a seasoned investor or just getting started, this channel is for you. No jargon, no fluff, just straight, practical advice to help you build wealth in any market. Thank you so much for watching today's 40-minute deep dive. Remember, investing is a long game. Stay patient, stay disciplined. And stay informed. We'll see you in the next video. Have a great day, everyone.